Greetings, Dr. Jeffrey Scott here. This is my weekend market update for the week ending Sunday, 6/08/2024. My email address is hgsidoc@gmail.com. Doing this on location at the Orange County Investment Seminar. Having a great time. Maybe next year more people will want to come. Getting pretty good feedback. I don't have one of my fancy mics, but it sounded okay when I tested a recording just using the internal mic on this computer. It's an Asus G16, and it's supposed to have a good mic. Well, guess we'll find out. Title, CPI, PPI, Fed meeting on deck. This is a really heavy news week. All of those, a Powell speech, and some employment numbers. If these numbers come in soft, then I think this market will be very happy. But if not, then I think the likelihood of cuts this year start to reduce in number further. And I think this market, where it's sitting today, is at risk. But let's take a look. Let's let the data show and not what some old guy sitting here in California thinks. Disclaimer. This is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. I pay for the tools that I use. And trading involves risk, and you'll are solely responsible for any investment decisions you make. Speaking of summits, the Wealth 365 is coming up July 15th to 20th. I'll put the link to register below the comments or in the comment section in YouTube. Would love for you to register with my name. I don't get any financial kudos or credit, but if I want to keep presenting there, I have to recruit, and that's how they measure. So I probably will be speaking on Saturday, although I have not heard the final decision about what time I'm going to get. If you like these videos, but you want something shorter and during the week, I invite you to go to stocksanddocs.com and fill out the little thing on the lower right, and that way you'll get notification when I post them. I don't post them every day. I post them most days when I'm not traveling and sometimes when I'm on the road. Major markets tell a story, and we did one of the things I did this weekend is I looked at the high growth stock boxes, which is an old-fashioned way of trading that I do, and it just reminded me that this market bottomed sometime around October 26th or 27th, and it was clear by the weekend of November 6th of 2023 that we began the next leg up. And the data is pretty impressive of how far we've moved. You can see the Qs, NASDAQ up 35%, the Spider up 30%, the Russell up 24.5% from the lows, the Diamonds 20, and the New York 22%. Considering the fact that is a little bit over 7 months and maybe 2 weeks, so 7.5 months, those are pretty massive returns. So if you haven't been long this market, to some extent, you've missed a big run. This week wasn't so good. You could see over 5 days, the NASDAQ in the composite, the Qs in the composite led, although they were down a bit on Friday. The S&P 500 was in the middle, down a bit on Friday. The Dow barely broke even, down a little bit on Friday. And then the NYSE was down 0.5%, most of it on Friday. And the Russell 2000 was down 2.20, more than half of it on Friday. So we limped into the weekend on what was a volatile week with mixed results. Technology, healthcare led to the upside. To the downside, utilities, energy, materials led to the downside. The Q-Edge tools just tell you how this market has rapidly changed from a bullish market to a much more difficult market. Here you can see on Friday, all the sectors in the S&P 1500 were down, 88% of the industries were down, and 74% of the stocks were down. You could see all the sectors were down. Here you could see, if you look over the 5 days of last week, almost all the sectors were down on the week, 81% of the industry groups were down, and 75% of the stocks were down. Over 2 weeks, it's more of a 50-50, but over a month, it's still pretty weak. So we are in a rough patch in the market. And June, July are typically weaker months in the fourth year of a presidential cycle. If we look at the wonderful Q market breadth tools driven by Metastock and Metastock Fire add-on from Sagar, you could see that over the last week we've had a couple of Hindenburg Omens, a Bango. We had 1 day of accumulation, 1 of distribution on the Dow rather. You could see that the 13-week new high, new low on a combined market breadth, which is NYSE and the NASDAQ, is not at a extreme. And you could see that we're probably weakening a little bit on the advanced decline and on the up-down volume. If I look at the NASDAQ and the NYSE, you can see the Bango was on the NYSE, on the NASDAQ rather, and the NYSE is the one that had the Hindenburg Omens. The market's definitely weakened into this week, and if you look at this and you see multiple dojis in a row, it's at minimum it's stalling. The question is, are there more to what we're seeing? And if we look at the major indices, you could see that, for example, the Russell 2000 is getting close to where you expect to bounce, looking at the 13-week new high, new low. That's the one that's the most beaten down. And you look at the Dow, it's still nowhere close to beaten down. If you look at the Nick Drendel Stock Market Workbook, you can see that ARKK led the market lower on Friday, so small cap growth, IWO is another small cap growth ETF. And you can see the major indices were down just a bit. You can see here that they closed in the lower part of their daily range. And you can see that we've now lost the 21-day exponential on the diamond, although it's still above the 50-day. When we look at the new high, new lows, you can see we got significant red, especially short-term over a month and 3 months. It's hard to make new highs in the markets when you have mostly new lows at the stocks. Looking over here on the right, you can see based upon performance, and I should have sorted on this, but you could see cannabis was up 1% on Friday, financials up 0.5%. Not a lot were up. 0.2 on cybersecurity, 0.1 on software. And over the last 5 days, semiconductors and crypto are in the lead. And look at metals and mining. Materials have really been selling off, down 6.2%. Now, white represents on the left the 30-year, on the right the 10-year. Yellow is the spider. So the spider on the weekly charts had new highs, while the 10-year came down. That's good for the markets. But you start to wonder, when the ECB in Canada have already done a rate cut, is the Fed going to do one to keep up? It'll be interesting to see. I wonder if they don't do one and don't hint that they're thinking of doing one, if that's going to cause some strength in the dollar, which would be bad for the markets. Recession in our near future, there's a question mark. There's always a recession in our future. But if you look at the 10-2 and the 10-3 yield curve inversions, they're below the black line, which is the break-even line, and the gray band represents recessions. They occur sometime after you cross back above. So I would not expect us to see a recession until the yield curve reverts to normal. When do I think that'll happen? After the inauguration. And do I think we're going to get a recession? I think we could get a doozy of a recession. Typically, the Fed overcorrects whatever they do, and that suggests to me that they'll keep it tighter for longer and result in potentially a significant slowing. But that doesn't matter to me tomorrow or Monday. I don't think we have a recession in the very near future. Why? There's no tightness in credit. Looking at the Bank of America High Yield Index Options Adjusted Spread, and the Philadelphia Diffusion measurement of economic activity is above the black line, and typically recessions occur when you're below -20. So right now, no recession in our future, near future. Breadth weekend, you can see stocks above the 200 here, stocks above the 40. Both came down despite the markets going higher. That's a divergence in itself, but what it basically is not giving us a signal because you're well off the top or the bottom. The powerful T2121 13-week new high and new low indicator is trending down towards a reversal area, but it's got days away from it without a major down day on Monday or Tuesday. Now, it's interesting to me that both the NASDAQ indices, which have been leading, are the ones that have the divergence. If you look at the NASDAQ 100, the AD line is turned down while the blue line of the Qs is still going up. If you look at the NASDAQ composite, the blue line of the index is going up and the AD line is going down. The rest of them are matched pretty well. That is potentially a canary in the coal mine that the NASDAQ, which has been carrying this market higher, even the NASDAQ 100, might be becoming more at risk of a sell-off. Current buckets is bearish. 73% of the stocks in the S&P 1500 are trading below the midline of their Bollinger Bands, but very few are above or below. So it's a neutral bear. It's not a reversal bear looking picture. You could reverse any time, but when you get to minus 90 or 90 in the red and 30-40% of the stocks below the Bollinger Bands, you typically get a reversal tomorrow. We're nowhere close. On the Hindenburg-Omen, a signal that occurs preceding almost every major crash since before the Depression. Typically, it's done on the NYSE, and you can see the NYSE has no signals going back to February of 2024, and for the most part has a lot of new highs and very few new lows. The NASDAQ, of which I put a video out 2 or 3 weeks ago trying to make the case that in the new norm that we live in, the NASDAQ might be more important to look at, and look at all the Hindenburg signals that are firing on the NASDAQ. Here they were in March, and here they are right now. And notice on the NASDAQ the preponderance of new lows. The reason we didn't get one on Friday is because you have to have about 2.2% or 2 point something percent low new highs as well as new lows to trigger. This worries me. This tells me more evidence beyond the AD divergence that we're in a precarious position on the NASDAQ composite and the Qs. When I looked at the EdgeRater warehouse tool to get a sense of what's working in the market, and I kind of eliminate the tail and the head because the number of stocks in those areas are very small. For the most part, it's a flat line just below the zero line. So it was a negative week a little bit on the broad markets. If you look at return based upon earnings, it was negative across the board, but less negative for those that had earnings. If you look at relative strength rank, the high relative strength growth stocks underperformed on the week. And maybe that's the story, market rotation out of high relative strength stocks. Here is imagine you bought each of these groups on Friday at the close and sold them on this Friday at the close. So for me, it was a funny week. Absolutely no change in my performance, even though I had more losers than winners. I'm okay with that on a flat to negative week. Notice what led. Gas in the tank, stocks with lots of earnings growth, up 3.7. Fagmenta, the FANG plus a few other stocks, up 2.95. When the shorting candidates lead, that tells you it was heavy rotation in the market. IBD Watch Ready was up almost 2%. My favorite pullbacks, waiting for single, were up as well. S&P 500 was up 1.18. The IBD 50 was up 1.08. Mike Scott's growth list of Focus 3 was up 0.67. There were a lot of negative lists down here, including the high relative strength stocks were down a tad as well. That's a large list. So I look at this, and what does it tell me? Market's confused. Leadership might be evolving, and it's still time to buy, really was last week, to buy the big cap tech. Know your news and earnings. I already mentioned CPI complex Wednesday morning, FOMC decision, and Chairman Powell afternoon. Thursday, jobless claims, and then PPI. So these 2 days are going to be major market moving. And then you got import prices on Friday. All we're missing is the PCE complex, which must be the following week or so. Earnings, you can see there's another heavy week of earnings. I'll be looking at some of these that I have a lot of interest in. things that might give us a sense of where this market is going. CrowdStrike, which seemed to do well this week. Oh, that's not March 4th. Oh, that's funny. That somehow when I downloaded, I got this one. I'm going to pause it and fix that. Well, that was weird and embarrassing, but here is the correct. This says April 22nd. This is bizarre. They're shooting. All right, well, that was embarrassing. What happens, and I go to Twitter, I search for earnings whispers, and usually the most recent one comes up top, so I apologize. I should have caught that one. The market thoughts, you could see Marcus Law gains led by the large cap MGK up 3.3, semiconductors 3.2, NVDA, NVIDIA was a big winner. Economic news was mixed. So we mixed into the weekend with progressive weakness Friday afternoon at around 2 o'clock. It would not be surprising to see volatility this week going into the PPI, CPI, and the Fed. In my opinion, economic data is too strong for the Fed to match the ECB in Canada with a rate cut. But we will be listening for Powell's tone and any changes in their statement. Add some employment data Thursday, not Friday, import prices. This will be an interesting week at the minimum. And I like to remind myself of these charts, which I show time to time. The blue line represents market bottoms. So one thing that somebody brought up at the meeting was that rates typically, market bottoms occur after rates start being cut. All right, so we have not cut rates. So here, the market bottom in blue, the rates have been cut. Here, the market bottom in blue, the rates have been cut. Here, market bottom in blue, the rates were being cut. Same here, same here, same here, and same here. So if the market bottoms occur after rate cuts, and we haven't had a rate cut yet, does that mean the market bottom is coming? And the other thing is, this is from NDR, it's ancient, but it tells the story. If you look at bear markets, all bear markets right here, the average is 31% down. If you look at bear markets that occur within secular bulls, which is the one that we were in, the average is here in the 22%. But if you look at bear markets occurring in a recession, in a secular bear, 36.9%. That's why we worry about a recession, because if we have a recession, we'd expect it to drop much further. The slide on the left basically suggests that we're not going to bottom until we have a cut, and we haven't had a cut yet. So let's go on and let's go into wealth charts. We talked a lot about different platforms this weekend in Orange County. And, I made a case that the reason why I use wealth charts for these videos is that the learning curve, I think, is simpler than some of the other programs. It comes with more basic feature sets than any other broker trading platform or many of the platforms you can buy, with scanners, data, charting, lots of educator stuff built in at no cost, including my basic tool set. And you get Rob Hoffman thrown in it as well. Now, I use other platforms too. I've got some tools that I introduced this weekend for TradeStation, enhanced tool set, as well as TradingView. But I still like to use, and my go-to for these presentations is using wealth charts. So let me tell you what we're looking at here. We are looking at the week that had, this was Friday, Thursday, Wednesday, Tuesday, and Monday. The white line here represents the close on the prior week. And if you go back 2 weeks, the close was the red line. In 3 weeks, it was the dot dash, dot dash, dot dash. So you could actually look here and see that we are less than 3 spider points of movement in the closes over 3 weeks. That's a pretty flat market, even though there's been movement, around the indexes. What else do I see here? All right, give me a mouse back. I see that we ended last week, the week before, on a high after a run up into the close. We gapped up on Monday. sold off and finished not very different from where we ended the prior week. You could see we finished just above the prior week close, so that was a little bit up day. Tuesday, we were up and down. We finished kind of flat. Wednesday, we traded much higher, and then we went sideways into the weekend. So really, all the positive move occurred on late Tuesday and Wednesday. If I look at the major market indices, I see a pattern that makes me a little nervous. On the spiders, we had a doji at the top with a program identified potential divergence forming. So that's two dojis in a row. Clearly, at the minimum, there's indecision there. Notice that all the bongos are green. On the Qs, we have two dojis in a row, indecision at the all-time highs. Bongos are green. The diamonds, so both of these had minimal movement the last couple of days. The diamonds, on the other hand, had a topping tail, and the diamonds are like oscillating around this 50-day moving average. At the end of the day, they were down 0.22, but they traded up and then closed close to the open, but below the open, so it's red. So, we're sort of struggling here at this 50. And then if we look at the Russell is, to me, is back into a Darvas box. And I'm not really going to be that excited until I break out of this box. It's got a 9-point range. It's not like it's been in the past, but it's back in a box. And if you don't know what I mean by the past, I kind of think that the Russell, I may have to go to a weekly chart to show you. Let me go into the weekly chart. That the Russell's been living in boxes for some time. Here's the box of 2021. Here's the box of 2022. And then on the daily chart, are we in a new box? Sideways motion. The Russell is clearly different here than the other indexes and the weakest of them. If I look at volatility in the VIX weekly, despite the volatile week, the VIX was down 5.42 to 12.2. That's pretty darn low. And you can see back for months, it hasn't really gone lower here. So a bounce in the VIX means the market's having a rough time. So we'll see. If I look at the dollar, which is one of the things that's kept this market alive, squirting out the bottom of this very strong channel, but we did break above the 50. So I think as long as we stay out of the channel, we're probably okay. But that's showing me some strength in the dollar, which is relatively new. Dollar strong, so I bet gold and silver might be weak. So let's see what we find out. Gold and silver both had big down sessions, 3.5 on gold and 6.5 on silver, both stronger dollar and weakening growth. Oil had a reversal here that we talked about in sort of a morning star. It has moved up several bars. It's still way below the 50 and below the 200. Natural gas, we'll see if it has a double shot attempt at the 200. And then maybe the most worrisome candle of the day is a 3.33% rise in the 10-year rates. And if we think that rates are important, this is a little scary considering we got a Fed meeting this week. And is this predicting something? I don't know. It could be. Notice it's up. I showed you earlier it was down on the week, and that's because it was down on the week. Let me go back here and just change this to weekly. And you could see on the week, but that's a bottoming tail bouncing off the 50 that, to me, this could go higher. So for the week, the 10-year was down 1.45%. So, but a strong up session on Friday. If we look at the weekly market timing, the three bullish indices, which are the spiders, the Qs, and the diamonds, have all been, by my timing model, in a long mode since November 6th of 2023. If the bottom was 1023 and 24, pretty happy when I'm within 2 weeks of the ultimate bottom having this buy signal. You can see the same thing here on the Qs from 11.6. There was a little whipsaw here and a quick reversal to a buy signal. The diamonds, which are sitting right on the WMA, therefore they are still would be considered in a buy signal here. And I'm not sure they came out of the buy signal here, and their original signal was also November 6th. The one that closed below the WMA is the Russell, the red bongo. So I've got two buys, 1 weak buy, and a sell. So at best, we're in a mixed buy mode, which is a lot tougher than in a strong buy mode. If I look at the sector hourlies, we're going to see where the strength was on a weekday on Friday, and it's technology. Communications is not bad, and the rest of the market looks poopy. Look at the sell-off in utilities. So not a lot of leadership. If I go to the stock scanners and I look at the heat map, I see mostly red, but the big cap tech kept the market up. So you look at NVIDIA. NVIDIA will split 10 to 1 when it opens Monday, so it'll be a $120 stock. Now, I'm concerned that that will lead to some profit taking. I think historically that's what we should expect. So we've got a 10 to 1 split technically occurring on Sunday. A breakout here is how far can NVIDIA run? Right now, it's one of the significant leaders of the market. Apple, which fooled us with some earnings questions and a big gap and a run, another big leader in the market. But these things are extended. How much further will they go in a tough market? AMD, not extended. Is it going to break out from here? So this is some of the leaders. Another great stock has been Costco, C-O-S-T, which is in a run. So if I was looking at a leaders list, I think Apple, NVIDIA, Costco are going to be in there. And, you look at Lilly, another stock that's really been leading as well. Wealth Scanner, does it tell us anything about leadership or lack thereof? I'm not going to look at bearish signals because I'm still overall long. Notice I've got only two things above 800. One is healthcare. Then I got semis, natural gas, pharmaceuticals, spiders, momentum, S&P 1500 rather, S&P 500, FANG stocks, and now the number's starting to drop. So I think as I look at potential things to buy, I might look at technology, semis, and healthcare. So let's go over to the CAT scanner, and let's start by looking at healthcare and see if we see anything come up to the top that's interesting. Well, the first thing is there's a lot of stocks in healthcare that are having signals here. Acro, I don't like the 200 just above it. Analim Pharmaceuticals, again, it's well below basing after a significant sell-off. Jazz, similar. Medtronic, I'm looking for something that looks good and attractive, and maybe Fathom, PHAT, is the best of the bunch so far. Breakout and momentum, it is above the 200. It's kind of a loose chart, and I'm not sure I'd be running out to buy it. I am in NVO, and just showing you that it's had a continuation from its cup and handle. All right, so healthcare doesn't really light my fire. Let's take a look at semiconductors. This tells me that there's no pullbacks and uptrends in semis. That's not a surprise because they've had such a big run. So let's just look at any momentum up in semis. And the one that came up is AVGO, and AVGO has earnings this week, so I probably would not spend a lot of time looking at it. Let's see about rockets, if there's any rockets in semis. All right. Other strong stocks, Taiwan Semiconductors. This doesn't require to have a signal today. This one's breaking out to new highs. This one looks outstanding. 4 dots a couple days ago. It's continuing. It's not extended. Probably of all the charts I've seen, the most actionable one thus far is probably Taiwan Semiconductors. Micron, it's got to take this area out for me to get excited. AMKR, another technology, kind of sideways. All right, let us then go look at all of technology. Genpact, below the 200. PayPal, not bad. Still got some areas to clear. Squarespace looks like a buyout. Apple looks great, but do I add to it up here? Let's see what the high-low jump is. Yeah, I guess you could. It's at 88. ACLS, a past leader, is running up to the 200. I made for it to clear. Analog Devices. I mean, this one looks like it's ready to run. I'd probably be doing my favorite drawing tool and drawing something here and setting an alert if it takes off above that area. All right. Eastman Kodak looked interesting, and this is a cheap stock, an old name. Run up, and you could sort of see a cup here, not extended. Relative strength and OBV look good. 2 launch indicators is a big deal. And then lastly, and I know this is a fast one because I'm not finding a lot of stuff that I want to run out and buy, let's just take a look at all the stocks. So it's going to filter for price and volume and only will look at stocks that are having some dots. So let's see, AGX, Airgain, beautiful chart, my God. Lower left, upper right, I put this in a leaders category. Earnings are out and they had 11% beat, woohoo. Volume breakout momentum, relative strength and OBV. Yeah, it's kind of extended, but for a leaders list, extended is okay. Would I buy it up here? Probably a little bit extended. ADP, sideways. Eastman Chemical, we looked at. 3M. Still got to clear at least this high before I get excited. Remax, no. Skechers. Wow, shoes have done well. Now look at the high jump when it pops up in here. It's at 100. My concern with Skechers, it's extended. ABM Industry, I used to think they made breaks. That's a beautiful chart. Breaking out, is it too far gone? Let's see the high-low jump. 57. It's not too high gone. So this might be one to take a look at. Chubb, a lot of the insurance providers, I think they must like the rates being where they are because there's a lot of good-looking insurance companies. So we are right underneath the trend line. We closed below it. A breakout above that would be interesting. Pinterest, a beautiful breakout there. I mean, it's not a stock that I'm in or I'm planning on chasing, but you could have drawn something here and it would have broke out on Thursday. I like breaking out among those higher highs. So let's see what I can put together here. BOIL is an energy natural gas ETF. It's starting to move, but it's well below the 200. Other things that might be interesting. CRWD was looking good, but this puppy stock has earnings this week. So actually, it says earnings this week, but actually it already beat. So this is one, because the earnings are out, that I might be looking at as well. And so I like to tell you the market's great, and I've got hundreds of great looking stocks to buy, and it's time to do a buy. I'm not feeling it. I think that we've got a lot of news this week. If I take any more positions, they'll be small with tight stops. If we could come out of that Fed meeting with an increase, not an increase, but a rate cut, I doubt it. Likely we'll hear higher for longer. And typically the first move is the wrong move. So I'm going to be careful going into that speech. Have an awesome week. This was a shorter video because I'm on the road. I think there are times to be aggressive and there's time to be careful. I'm going to put this as time to be careful. We'll see you next week.